Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is March the 13th, 2024. I want to comment on this. The market has been going up and up and up since about January 1 of 2023. So that's about, shall we say, 14, 15 months. And it had, with very little correction, a couple of minor corrections, but it's pretty much been a bull run. There are people who believe that the market is going to keep going from here. And I don't know how far they think, but that's what they believe. There are others who think it's overbought and it's ready for a correction. My feeling is that I think it is going to keep going until it doesn't. And at some point, it's going to correct. And so my attention is very focused on downside protection at this point. Okay, I'm going to jump into the dashboards. And so begin with this one, which is, these are as of last Friday. And this is March the 8th. And you can see a very unusual chart, very unusual picture. These are the four top U.S. indexes, the Dow, the S&P, the NASDAQ 100, and the Russell 2000, and two foreign indexes, the EFA and EEM, the developed markets and emerging markets. And then finally, at the bottom is the long-term treasury bond, ETF, TLT. All six of them are above all four of the moving averages that I illustrate. The 20, 50, 100, and 200-day moving averages, that is represented, they're represented by a green dot to the right. So if they're above those averages, it's green. If they're below, it's red. So this is showing a lot of strength in the market as of Friday. The yellow box shows the gains or losses by each of those indexes for the past week, and the pink box shows the gains or losses for since year to date. So you can see that starting from the strongest on top down to the weakest, you can see where they stand. The S&P is actually on top. The NASDAQ 100 is right below that. Developed markets, Russell 2000, Dow Industrials, etc. At the very bottom, you can see the long-term government bond, ETF, TLT, is negative 3% year-to-date, but it is still above all four of the moving averages. This takes the S&P 500 and breaks it apart into the sectors within the S&P 500. You can see on the lower right there are 5 red dots. So this shows that telecommunication is the weakest, and it is below all 4 of the moving averages. So I don't know why that is, but that's what it is. And then consumer discretionary below the 20-day moving average. Everything else is positive. And they begin with a gain of 8%, working all the way down to a slight gain, and the last 2 are negative. This is the S&P 500 on a 18-month weekly chart. So 1 move equals 1 week of results. And you can see that during this period of time, 2 or 3 minor corrections, but really other than that, it's basically been going up, and a slight tick down this last week, but by and large, it's still in an upward trajectory. This is a relative strength chart showing the S&P 500 growth stocks relative to the S&P 500 value stocks, SPY-G versus SPY-V. So if it goes up, because of this ratio, if it goes up, that favors growth stocks. If it goes down, it favors value stocks. So you can see, again, this is 18 months, so you can see from the beginning of 2023 that it is mostly favored growth stocks, except for last fall where there was a big correction where it favored value, and now it's pulling back, and that looks like it's favoring value again. Another relative strength chart showing the S&P 500 relative to the Russell 2000 ETF IWM. And it goes up and down a lot, but the general direction is positive, is in an upward direction. And what that means is that large companies are performing better, are more in favor than small companies. So when it goes down, it shows small companies are. And the times it goes down are limited, but in general, the direction is upward. The long-term government bond ETF is TLT, and it had a positive week. You can see that in the very end of the chart, there is a slight tick up, and that shows you the last week of the long-term government bond was positive. But the long-term trajectory, this is a 54-month chart. Over most of that period of time, you can see that it is a downward direction, meaning interest rates have gone up, and bond prices or bond ETF prices have gone down. The dollar is the same thing. It's gone up and down a lot, but the general direction over a 30-month period is that the US dollar is stronger relative to other currencies, because we're the reserve currency. If the dollar goes up, it has to go up against something, and it's going up against other currencies, mostly European currencies, but in general, it's stronger against most of the other currencies as well. Gold, represented by the ETF GLD, look at that spike up at the end. For the last couple of weeks, I don't know if this is 2 or 3 weeks, gold has been on a surge. And so it kind of was lackluster for a while, and now it's taking off. So hooray for gold. So if you have gold, I don't know if that means, you want to buy more or you want to sell, that's up to you. I'm more of a silver buyer and owner, but I don't own it or buy it, or certainly don't sell it for investment purposes. I buy it as an insurance policy against the decline or the eventual decline or collapse of the dollar, which I hope does not happen. But if it does, hard currency or precious metals like silver or gold tend to hold their value. Silver, same thing, couple of weeks up. It doesn't look like as much, but it is as much for this past week in silver as gold. So it's been very positive for both precious metals. Relative to each other, you can see that over a period of about a year or so, a year plus, that gold has outperformed silver. And because of that, on a relative strength chart, it shows gold, actually the line is going down, and that favors gold. If it went up, that would favor silver. Bitcoin has been on a run for a while, and since the fall, and it is surging right now. So, and as I'm doing this today, it's up another 4% plus. So it's, there's a lot of theories behind it about the halving coming up in April, and but people and the institutional buyers coming into the market, but and whatever the cause is, it is definitely attracting more buyers than sellers, and from a supply-demand standpoint, that's forcing it up. The volatility index is just an index. It's not an asset really, and it went up, which shows more downward volatility in the market, more so than recent past. And look how far away it is from my black line, where I put at 24, which is the threshold where I think risk starts to increase significantly. We're way below that. But it's down around 14, and it was down as low as somewhere in the 12s. Asbury Research went from 6 indicators, Asbury 6, went from 6 indicators that were positive over to 4. That is still positive, but 2 of them have now turned negative. The cross-asset relative performance chart on certain assets shows that stocks are stronger than bonds, high beta is better than low volatility, the broad market is better than the blue chips, the Dow, and the broad market is also stronger than the technology stocks, mostly technology, which is the NASDAQ 100. U.S. versus the world, there are some countries who are starting to show strength against the U.S. These are their stock markets. This is not their economy, it's not their currency. So, for example, Peru, Italy, the Eurozone, Japan, South Korea, and the Pacific. So, a couple of European countries and the region, and a couple of Asian countries and the region. Other than that, the U.S. is stronger in a number of these markets. Mexico and Brazil, for example, the U.S. is stronger in all 3 periods, the last week, the last month, the last quarter. So I picked Switzerland. I've been showing Switzerland, so the ETF is EWL, so I picked that one just to show you what it looks like on a relative strength chart. You can see if it goes up, that's favoring the U.S., which is SPY, or if it goes down, that is favoring Switzerland. But in general, the trend is still in an upward direction, and this would just be representative of a European country. Gold and silver, the spot price on gold is $21.77, up 4.5% last week from the previous Friday. Silver up to $24.31, which is up 4.9% from over the previous week. So very strong gains. You didn't see the silver as being up more than gold on the chart because it was just 1 week, but gold had like 3 weeks where it was up, so that made that look more exaggerated. The gold-silver ratio is still 89-1. A monster box of silver, 500 rounds of generic silver, is $12,685. It's not a bad way to buy some if you want to buy it. If you buy a sleeve, it costs 50 cents more per sleeve, but the cost per round in quantity of 500 is $25.37, and that goes up 50 cents per round if you buy it in a tube of 20. The spot price, look at this. The spot price is down. Excuse me, not this.
Just start the spot price.
That's okay. You couldn't hold it on.
No, I tried.
I know. I'm like that sometimes. Okay. So silver, monster box of silver, 500 rounds, generic silver, is $12,685. This equates to $25.37 per round when purchased in a quantity of 500. That goes up 50 cents to $25.87 if you buy just a tube of 20. And look at this. The markup is $1.06. Boy, that has come down. And that shows that the demand right now is not as strong. So people who are shoppers, you're getting a good value today. However, you're paying up for it because the price of silver has gone up. It didn't go up, in my opinion, because of supply and demand. It went up because of manipulation. And most people know that or think that. I get this information from my son, Preston, who is in that business. So people have asked me, by the way, where do I buy a monster box? If you want to contact me, let me know and I'll introduce you to Preston. The other alternative is you could buy locally where you live from a brick and mortar retailer. I don't recommend buying over the internet, but buy from someone who you know or a brick and mortar company in your area. You may remember the great Peter Lynch of the 1990s, and he was the manager of the Magellan Fund, Fidelity Magellan Fund, which was the darling of the 1990s, which was a go-go period. And but then he stepped away, and I don't know the story behind the story, but he said this: you get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. We have had about 15 years or so from the last severe crash. And going back 220 years, there have been about 22 crashes. In the 1800s, they called them panics, and a decline of 30% or more. I'll call that a crash. And some of them, so 22 in 220 years, that's about one every 10 years. So some are closer together, some are further apart. It's now been 15 years since the last crash, and I don't interpret anything since that time, 2022 or 2020, as a crash, not by the definition I'm using. So we are overdue for a crash, not a correction, a crash, a collapse. When is that going to happen? I personally don't think it's going to happen this month, this quarter. It may not even happen this year. I know some people think it might, but I don't believe that. But I would say in the next year or two or three, at some point, we're getting so far stretched out in overvalued stocks that this has got to go through a major correction, a crash, in order to reset everything. Now, that's painful. I don't want that to happen, but I'm just saying that so that if you're an investor or someone invests your money for you, think about that, because losing half your money is very hard to recover from. And you may remember or know people who went through the 2008 crash or the 2000 crash. Those were very painful periods. And so I saw Peter Lynch's quote, and I thought it was apropos, just as a reminder that markets do go up and markets do come down. Be prepared so that if this happens, you have a way to defend yourself, protect your money, or protect most of your money, and not have to go through that kind of loss. So thank you for watching. If you have questions or comments, leave them in the comment section below.